how frequently, how regularly they are going to paying that their debt. So here the credit rating agency is going to be evaluating the individuals or companies or governments financial positions, or else how they are going to maintaining their balances by using their existing returns. So that's the reason these credit rating agencies, CRAs, are going to evaluate in the individual companies and the governments um, creditworthiness. And what are the objectives of the credit rating? So here we can see some objectives, that is to evaluate the financial stability of borrowers. For example, an individual, they are going to checking about over the past 6 months or else 1 year. So what is the financial stability of the individual or the companies? How they are going to maintaining their returns and how they are going to utilizing their funds appropriately to their organizations or for their individual persons. So it helps investors make informed decisions. So credit rating, for example, if you're going to applying for loan, the bankers or financial institutions are going to be checking that history. So that's the reason investors make a informed already. They are going to getting the information about that those who are going to apply the borrowers. So they have a borrower's complete information. So based upon that, the investors may issue or may not issue. That is their interest. That is their decision. So here and also to reduce information symmetry between lenders and the borrowers. Symmetry nothing but how much and what is the rate of interest, what is the tenure, how much they want to charge from the borrowers. So the lenders used to fixing the terms or that payments are unequal terms, and also to provide a benchmark of interest rates and loan terms. Here benchmark for interest rates, how they are going to looking about that how much they are going to charging. For example, personal house loans, and an average 8 to 9% rate of interest will be there. If you're going for personal loans, that may be 10% to 13% or something. So if you're going for some other commercial loans, that may be increased. Here the bankers to banker is different, and NBFCs to NBFCs also are different. There are the different types of uh, loan terms and interests are there. Now, who are the key players? That is the credit rating CRAs. That credit rating agencies, who are players who are going to checking in a little in a global side, in a global agencies are Moody's Investor Service. This is one of the leading and prominent CRE, that credit rating agencies, and Standard Poor SP. S&P also one of the leading credit rating agency, and also Fitch Ratings. These all are the global agencies. They are going to give the credit rating to the particular individuals or the institutions. And what are the Indian agencies? Let's see here the CRISIL, ICRA, K, and IR. So what is the CRISIL here? Credit Rating Information Services of India Limited. So one of the private limited company, that is a credit rating information and services they are going to providing to the Indian people. So in India, CRISIL is one of the important thing. And also ICRA, that is Investment Information and Credit Trading Agency. ICRA also one of the leading now civil credit rating agencies in India. CARE also, CARE, Credit Analysis and Research Limited. How even also this also providing that credit rating agency, credit rating services to the individuals or the companies, and also Indian Rating Research, Ratings and Research IRR also one of the credit rating agency in the India. Now, what is the credit rating scales? How scale is going to be there for the investment purpose or the speculative purpose? In the investment grade, there's a high credit worth. For example, the individual or the companies are going to getting triple A or double A, single A, or triple B. So that is means here there is a credit worthiness is there to the individuals or those who are taking that borrowers. So the borrowers, if they're maintaining about the triple A, double A, or single A, or else a triple B. So these two or three to these are four are going to high credit worthiness of the individuals. So company, if they are going to looking about that there is a simple triple A or double A or single A, B, triple B, they are going to checking about that they're eligible for the high creditworthiness. And the speculative junk grades also is there. There is also high risk of defaults. For example, those who are not paid regularly, they are missing their payments, their EMIs, or else they are default to the particular bank. They are giving double B, B, triple C, and D. These are the grades are going to giving by the credit agencies. And the factors affecting the credit rating. What are the factors affecting the credit rating agencies? Factors here: financial performance, repayment history, industry outcome, management efficiency. So here that CRS are going to providing information to the investor. If they are going to providing means depends upon their performance, that financial facts may be effective. So here the financial performance, the revenue, profitability, and debt levels also be effect on their company or their organizations. So that's the reason, if you want to maintain the financial performance, we have to pay that what are the dues or that repayment amount is there, that we have to clear it immediately. Then that may not affect on the financial performance or the debt levels or revenues of the particular company. Repayment history, that means is an important factor to the some people used to missing their dates. For example, one person has to pay about particular date or fifth of the particular month, that person has to repay that particular EMI. If you are going to missing means you are going to overcoming that repayment date. That means you are missing the repayment. So they're going to checking about the past credit behavior and default risks. So if you are going to provide as an investor, if you are going to providing loan to the particular individual or companies, they are going to looking about the payment history. That is repayment history. And industry outlook, it depends upon sometimes industry. For example, pharmaceutical industry or manufacturing industry or telecom industry. If they're going looking about if you're going to investing money to the particular organizations, how that organizations are going to utilize the funds, or whether that um, industry has a good sales or not, or revenues or not. So that's the reason they are going to see about the economic and sectoral conditions of the particular industry. And also management efficiency. Here the governance and decision making quality is also one of the important factor of the credit rating, that is good affecting the to the organizations. Now, what is the importance of credit rating? Let's see here the for investors purpose this is important, for companies purpose this is important, and also bankers and lenders purpose also important. So as an investor, that helps in choosing safe investment, which is that what is that how is that investment is going to be useful to the particular to the organizations. So companies also determines the borrowing cost and access to the capital. So companies, for example, bankers want to give a to the companies. The companies must assess their cost and expenditures. And for banks and lenders, it helps assess lending risks and interest rates. So how that interest rates also is going to be there, affecting on the lenders versus bankers. And the key features of credit rating. So it measures the credit worthiness and assigned by the credit agencies. So it helps the investors and the lenders assess their risk associated with the lending money. If they are going to taking loan from the lenders, how that borrowers are going to paying, how that person is going to having the credit worthiness. So that helps. That is one of the key feature of the credit rating. Sorry. And assigned by the rating agencies. So we have discussed now agencies Standard Poor and Moody's CRISIL, the provided rating agencies in the key features, playing the key features in the credit ratings. And also here the different rating scales that we now that ratings are given by symbolical symbols like AAA, AA, by that is investment grade, and B, double B, and triple C, D, it is speculative and junk grade, and how its effects on the interest rates also. So if you have a good CIBIL score, that you may eligible to take the loan immediately without charging more interest. So here there a higher credit rating means lower borrowing cost, while a poor rating increase interest rates. So the people, those who are not going to paying regularly, if they are not able to maintain the proper CIBIL score, that may affect on their loan interest also. If you're going to apply for loan, that may be showing there in the when they're going to logging in the applications, and also used for bonds and loans. So companies and governments receive credit ratings when issuing bonds or rating loans also. At that time also, the companies are looking for the funds, they are raising funds, they're issuing the bonds against uh, to the fundraising. So that is also effect and the effect to the particular organization, because if they are not maintaining proper CIBIL score, that certainly affect on the individual's level. And example of credit rating. So here, suppose a Tata Steel Limited issues bonds to raise a fund capital. So what is happening here? The credit rating agency example, CRISIL, evaluates the Tata Steel financial statements, revenue, liabilities, and market position. So if Tata Steel has a strong financials, it may receive an AA plus rating, indicating a low default risk. That means nothing. It's in a high credit worthiness is there. So that's the reason. That's the reason the credit rating is going to helping to the organization. It may be in a positive or negative way in two ways that may be affecting on the individuals and the companies. Example of individual credit score. So if a person applies for a home loan, banks checks their CIBIL score, that is in India, or FICO score in USO. So in India, they are going to checking the CIBIL score. So depends upon CIBIL score only that person is going to eligible to take loan or FICO score in USA. For example, that person, some people used to stay in USA, they want to apply loan from the India. So in that cases also, they used to check that FICO score. And if individual's score is 750 plus, they are considered creditworthy and get lower interest rates. So those who are going to maintaining more than 750 CIBIL score, so they are considered as a creditworthy and get lower interest rates. If their score is below 600, the bank may reject the loan or offer it any at an high interest rate. So below CIBIL 600 score may be helpful to the organizations to charge more interest, because there's a risk is going to be there. That person is not going to pay regularly. That may shown. That reason that is a high interest, high interest risk. Credit also is going to be there. What are the limitations of the credit ratings? So it is subject to bias and conflicts of interest. So here that person is going to applying for loan. If the person is going to is earning about 50,000 rupees per month, but is applying for 20 lakhs or 30 lakhs something. So that is a bias. The complete difference between the um, individuals and the bankers, and depends upon his CIBIL score. The person is going to applying for CIBIL. If some person is going to be um, the person is going to be applying for loan, the bankers is to check their civil score. If the civil score is good, then the people, the bankers may issue the loans to their particular applicants. And also, ratings may not always predict a sudden financial distress. So, for example, sometimes that may not affect within 1 or 2 months, up to 3 months. That may not affect, that may not shown in the balance sheets of particular organization. So individual civil score is different than companies. So company to company is different, and a company civil score is that is different kind of civil. So that institutions, whether they are going to providing good or not, uh, that may affect on the individuals or the organizations. Because if that good position company may apply for uh, high um, high investment, how high loan of amount. So that's the reason companies if they maintain a good CIBIL score, they may also eligible to take more revenues in the future also. And it depends upon the historical data that may not defect the returns score. For example, over the past 5 years, the individual doesn't pay the civil score. He has used the civil um, creditworthiness, but in the creditworthiness is completely turning fall because the person is not going to providing or not able to maintaining the proper civil score. That's the reason companies is going to charging more rate of interest rate. Now, here we are going to discuss about venture capital and private equity. What is the difference between um, individuals, venture capital and private equity? Can anyone say here what is the civil score of what is the civil score of particular candidate? So depends upon the um, civil score, but that venture capital may be affecting. So let's see what is the venture capital. Venture capital is a form of private equity and financing provided to the early stage, high potential startups and small business. That means if the persons are going to having the applying for loan in the beginning stage, that is a venture capitaling. Venture capital is a form of private equity financing provided to early stage, that is in the startups companies, the high because of their high potential startups and a small business. So in the VC, venture capital firms invest in these companies in exchange for equity, aiming for high returns when the company grows or goes public. Until unless that goes to the public or the company may not may be eligible to take the loan or not. So venture capital is completely the new strategic company. They are if they are going to want to if they want to maintain or want to get more returns depends upon the investors' decision only. So the person is going to be maintaining the civil score for the future purpose. And what are the stages of venture capital investment? Here, what are the stages? Now, let's see that there are the 3, 4 stages are there. The stages of the venture capital is the seed stage. That means initial funding for product development and market research. So here the seed stage is the initial funding of for product development and market research. And early stage, that is a series A by B, that is expansion and customer requirement. So you're going to crossing A and B section, that is you're going to expanding the customers acquisition. So in this stage, in this venture capital stage, seed feeding is one kind and first early, and also growth stage. There is a series of C and beyond. So scaling operations and preparing for IPS or organizations. So if they're going to providing organizations, there will be a good growth. So seed is in initial, seed stage, the initial stage of the organization, and fairly stage services. That is individuals and customer uh, acquisition. So how you are going to pick up in the new customer in this market. So as a entrepreneur, they should go in, you know, uh, in the expansion of the customer acquisition and also growth stage. So here the series of C and B and growth stage. So scaling above and growth stage, early stage, and seed stage. They are the three stages of the venture capital. Now, example of venture capital firms. So here there are examples. Four examples are there in the venture capital. That is Sequoia Capital, Ekel Partners, Anderson Horowitz, and Tiger Global. We famous is that one of the Tiger Global is one of the venture capital in the world. So in the Tiger Global, that is going to funding to these startup companies. That startup companies may take the loan from the this Tiger Capital as a venture funding. So venture nothing but it's a initial funding to the organizations. And what is private equity, PE? So private equity refers to the investment in mature companies with growing uh, potential. So how this private equity is going to referring to information and operational, it conveniences are underperformance. The companies used to um, mature a companies with growth potential. Growth potential is there. Then they are going to providing the loans to the investment. They can refer to the market. And how that organization's efficiencies and underperformance. How that company once that started, after getting started, what is the financial position and what is the growth potential, what is the operational efficiencies, inefficiency, and what are the underperformance of the particular. This is providing by the private equity. Unlike venture capital or private equity, firms acquire significant stakes or full ownership of companies to return, restructure, and improve their performance before selling them for profit. So if you are going to exist, if you have existing company, if you're unable to modify it, if you are going to innovate, if you are going to change in the organization, so the private equity is available to the that kind of particular organizations. So venture capital or uh, private equity, it's a very significant stake, full ownership in the uh, companies. And what are the key features of private equity? Here, it focuses on that private equity focus on mature companies with stable revenues. So how stable that companies is going to taking are getting the returns uh, over the past 5 years or 3 years. So that is the important fact is that civil score also very one of the important factor in the private equity. And the private equity refers firms aim to improve operational efficiency and profitability. So here, PV aims to with improve operational efficiency and create and profitability. And funding is raised from national institutions. Pension plan also is available for the applicant account holder. So, so as a venture capital, they have these kind of features. So, as you know, we can understand thoroughly about the venture capital. And types of private equity investment. And what are the types of private equity investments? So here, buyouts, growth capital, distressed investments, and fund of funds. So these are the types. What is the buyouts? Um, Private equity, it's acquiring controlling stakes or full ownership. Example, leveraged buyouts. That is LBOs. Leveraged buyouts nothing but it is acquiring complete buyouts. Nothing to investing completely. They are going to taking into this thing. So they are going to leverage. They are going to owning that particular organization and a growth capital. Here, another type is that investing in established companies to expand operations. So some companies is looking for growth, but there is no capital to expand their business operations. And in this case, growth companies, though we may see in the market how many companies are there in the growth level, so that companies may uh, establish their companies to expand their operations. For that, these companies may be useful. And distressed investments. Here, the buying them, aligning them, and restructuring them. So, what is the distress here? Buying underperforming firms and restructuring them. So, these are the example was given by the professors. Uh, let's say in this class. So, depends upon that the company may be um, distressing or whether the company is going to get growth level potential or else normal version. So it depends upon that only the key equations may be useful to the organization. And and uh, distressed investment. That means buying underperforming firms and restructuring them. So already existing company that was not useful or they're not going to providing a contemporary product. So in that case, they are going to meeting them and they are going to marketing with them. Then finally, you are going to taking that 30, 33 lakhs of the human resource management. Um, 30 distress underperform and restructuring. So the companies may be buy underperforming firms and investment decision. and fund of funds. So fund of funds is about investing in the capital PE funds rather than and what are the examples of private equity firms? Let's see examples here. Blackstone Group, KKR, that is Kohlberg Kravis Roberts, KKR, and Carlyle Group, Brain Capital. So these are the private equity firms. They are going to providing the services to the investors or the distressed companies, or else for the new already existed in the market and unable to run the business operations. In that case, these four, Blackstone Group, KKR Group, and Carlyle Group, and Brain Capital, these are the four. They are going to providing that civil score tips and civil score results are interest. And now let's see what are the key differences between venture capital and private equity. So some based upon some features, we may understand about the company's financial performance. Now here features of the capital funding and debt funding and venture capital and private equity. What is the feature here? The stage of investment. How investment was is going to be there in the venture capital. So in the venture capital is the early stage startups. So in the stage of investment process is in the early stage of process known as a venture capital. But in the private maturity, it matures the business operations. That means already existed business and they're running the business operations. So sometimes they also use for funds to the particular organizations. So that's the reason that investment, early stage employment and mature business is that ask them to report to the particular person. So you may and risk level, ownership stake, funding structure, and exit strategy. So these are the key features of the venture capital and um, venture capital and private equity. Let's see here. At least as here the risk level in the venture capital risk is high, but in the case of private equity, that is a moderate to low. Here, ownership stake. Here in the venture capital, the ownership is that minority, that because they are giving funds to the new companies, so startup companies. But in the case of private equity, that is the majority share is going to be there. Or else sometimes full ownership also is there. The full ownership are the majority share is going to be there because they are going to investing money on the sick companies or distressed companies or else matured companies. And the fund source here in the venture capital, that is a limited partners and Hindu undivided networks. So um, in the venture capital, there is a limited partners are going to be there in the startup companies. But in the case of private equity, there is institutional investors and pension funds also is going to be there. The pension funds, nothing but, they are going to providing pension funds to the even to the organization. So institutional investors are going to providing, because institutional investors are different, pension funds are also different in the private equity. So these are the two types of funding source also is going to be there. That is the difference between the venture capital and private equity and exist strategy. Here, the IPO. IPO is the existing strategy of the venture capital. That is initial public offerings and also acquisition mergers. So here, acquisition is going to be possible. Initial public offerings and acquisitions mergers will be there in the venture capital, because this is a startup company. The startup companies is having IPOs or else acquisitions mergers. They may accept and expect that also in the beginning stage. But in the case of private, even IPOs also is be possible. And major thing is that in a resale option is going to be there, because they are the sick position or else in the distressed positions. This private equity is going to entering under, they are going to investing money to the particular organization. So the resale is going to be applicable. And also LBO, that is leveraged buyouts. That means complete purchasing. Leveraged buyouts, nothing but complete purchasing is also available. That is in the private equity. So the private companies certainly they are going to taking into the consideration. That is a difference, major difference between the private equity and the venture capital. So in the case of feature, the stage of investment, risk level, ownership, funding stake, funding source, and exit strategy, that all are important factor in this organization's level. So when you're going to investing money, if you're going to taking a loan, we must understand these concepts about the venture capital and the private capital. And another thing is that what is the importance of venture capital and private equity in business growth? So how the business are going to be considering the growth in case of in the venture capitals and from private equity. So venture capital, it's a fuels innovation, the complete new thinking, new thoughts, a new concept in the venture capital by supporting startups with disruptive ideas. So without changing, without disturbing their ideas, that companies are going to, that venture capital is going to providing the um, startups to the startups and disruptive ideas to the existing new companies. That is the, it fuels the innovation in the organizations. That is known as venture capital of like working as a fuel and a complete innovation concept. And um, here, private equity. Private equity helps businesses scale how that business was there, and whether middle scale, middle level, high level, low level, and distress level, and what kind of level is going to be there. So that private equity helps in the business scale by improving efficiency and restructuring the operations. So improving how that efficiency is going to be there and restructuring operations in these organizations level. So venture capital is going to sorry, private equity as helps the business scale by improving the efficiency of the and restructuring operations. And both contribute. This venture capital and private equity is going to contributing and expanding industries. So how that industries are going to be expanding and creating the jobs and economic growth, how these are the helpful to the organization in terms of contributing to the economic growth of India, and how these companies are going to providing creating the jobs and expanding business industries, expanding business operations across the globe or the domestic level. So these are the major concepts in the venture capital and um, private equity. So far, we have discussed about all these things. Now, in the coming class, if there, then we have discussed about this leasing and hire purchase and installment system, factoring and fostering, custodial services, and other services will be should be discussed. So once we have let's see the glance about the today's and concept, that is a block four financial services too. So that is a merchant banking, mutual funds, credit rating, venture capital, and private equity. So far, we have discussed about all these four in the last class, this class. So merchant banking, but it refers to the broad categories of financial services designed to help a business accept and process the payments from customers. So these services are integral to the modern commerce and enabling transactions through various payment methods such as credit cards, debit cards, and economic payments and mobile wallets. These are going to provide by the merchant banks. So merchant service also is provided by the financial institutions, banks, and specialized payment processing companies. So that is what I and mutual fund also is a financial instrument that pools money from multiple investors to invest in a diversified portfolio of securities such as stocks, bonds, money market instruments, or other assets. So here the mutual funds are going to providing multiple investors to invest in a diversified portfolio of securities such as stocks, bonds, money market instruments, or other assets. And these mutual funds managed by the professional fund managers, mutual funds provide an opportunity for small and large investors to access professionally managed portfolios and benefit from economies of scale. So how the people are going to want to get more revenues, more returns on their investments. So, so how that mutual funds is going to be giving returns to the particular investors in this concept. Now, crediting nothing but crediting is an assessment of borrower's ability to repay debt. So, if the persons are how to pay the debt, how that person has to pay, how much they want to pay, when they have to pay, that how many times they miss the repayment system, and based on their financial history, current financial positions will be they're going to knowing that by the investors. So it is usually assigned by credit rating agencies, that is a CRS, which evaluate individuals, companies, or the governments to determine their credit worthiness. How that people are going to considering these concepts. And now let's see venture capital. Venture capital is in a form of private equity financing provided to the early stage and high potential startups and small businesses. So those who want to loan to start their business operations in the initial stage, this venture capital will helps to them, and this VC firms will invest in these companies in exchange for equity, aiming for high returns when the company grows or goes public. In the same way, and uh, private equity is also, it refers to the investors in matures the companies. That means already existing companies, how they are earning, how much they are earned, and what is their growth potential and operational influences, inefficiencies, and performance. So how these are going to be there in this existing company? These private equity companies are going to checking, and based upon that, they are going to issue the loans to the uh, that particular companies. And unlike VC, the PA firms acquiring significant stakes or full ownership of companies to restructure and improve their performance before selling them for profit. So the companies into this sick position, or else in a destructive position, or else the companies unable to pay. So here the buyout policy, or else LBO, leveraged leverage buying options is buying of by buyouts also is there, and also complete resale. That means are completely complete owning, or else majority share they are going to purchasing in this private equity. So these are the major concepts in the financial institutions too. So in the coming in the class we may discuss about the there is that is a another we will come with another concept. So thank you. We are winding up the class.